to work the other one, and Mark told me it was a disaster. So here we are.
But you sound so good right now. Well, like butter. It's good.
Well, if the feed is not sounding good, just tell us in the comments there, and we will let you all know, or we'll fix it and do what we can. So what we're going to do is Mark and I are just going to start fielding some questions and just kind of talking how we're seeing the market. And let me just throw the first one up here for us. And I've got to draw. Hold on, I got a little technical thing I got to do here. I got to drop these into. Oh boy, they all loaded at once. I am such an amateur at this, but we'll get there. We'll get there with more practice.
Hey, this is better than the last time we tried it, where we couldn't even get on.
We couldn't even get on. Yeah, that's right. We were just a total disaster the last time we tried this. Okay, so here's the first question that I'm going to pull up, and this one is from Victor. I have previously, about 2 years ago, heard Mark Yusko say that he bought Bitcoin. He thought that it could reach the market cap of gold, but not higher. Is he still of this opinion? And if yes, why does Bitcoin, he think, might steal store of value properties of real estate and bonds?
Yeah. So a couple things. One, definitely not higher. So I did say that, my long-term view on Bitcoin was that it was going to become a gold substitute, digital gold. I even talk about it on Twitter with a hashtag digital gold. So I don't think it's limited to the market cap of gold. There's about $8 trillion of market cap. And the reason I think it moves in that direction and why it does displace other stores of assets, but it's not a replacement for. This isn't necessarily zero sum. There'll be a little bit of displacement. But overall, if you think about why do we have stores of value, it's because they are scarce assets. So, what's the best performing asset over the last 10 years? Everybody says, I don't know, stocks. Nope, not even close. Collectible Porsches. Why? Well, because there's only 3 guys in the whole world that buy the collectible Porsches: Jay Leno, Jerry Seinfeld, and John Shirley, the number 3 guy at Microsoft. And they basically pay stupid prices so they can have a car and they put it in a garage and buff it with a cloth, which I think is kind of a waste. But that side, the most scarce assets are the best stores of value. And Bitcoin has this thing called the halving, which is coming up in 45 days, that limits the amount of new flow to the existing stock. And other than gold, which has the best stock to flow ratio in history, and that's why it's been a store of value for 5,000 years, the antithesis is fiat currency, which we all just saw trillions with a T printed out of thin air. And that will eventually erode the value. And Bitcoin will continue to be a store of value. But real estate will be fine. It's a good store of value, although the real estate market is about to get crippled. I mean, crippled. And we can talk about that later, but it's going to get ugly.
Let's talk about it, because there was another question in here that was wanting to know about real estate. And I mean, everyone has some type of real estate for the most part if they've purchased a house. So I think people were very curious about your thoughts on that.
Yeah, I mean, there's so many things that are just going to slam real estate here. So everybody says, oh, interest rates are low, so prices have to go up. Well, okay, that's fine. But we just took 10 million, and that number is probably light by half. So 20 million people pushed out of work. No sign of when we're all going to get back to work. And people aren't going to be able to pay rent. They're not going to be able to pay their mortgage. And are banks going to foreclose? I don't think they're going to foreclose right away. But I'll tell you what's really going to happen is there's going to be a ripple effect from the people who had a property, then they levered up that property to buy another property, then they levered up that property to buy another property. And you see this like an Airbnb, right? If you had an Airbnb property, it was a nice little business. And they're like, oh, if I can do 1, I can do 2, I can do 10. Well, if you have 10 properties that were all cash flowing quite nicely pre-COVID, now suddenly no one can travel, and so you have no revenue, that's going to unwind. And when those unwind, that's going to put pressure on markets. And with people out of work, I just think it spirals in a way that we can't even really comprehend yet. And that's probably a theme we'll talk about a lot tonight, that we're just at the beginning of the great unwind. And it's all precipitated by what I think is a overly zealous response to a normal threat. And everybody wants to make COVID into some big esoteric, egregious threat. But when you look at the data, it's not really that different a threat than other things we've seen in the past. But the response, never seen anything like it. We've never shut down a global economy in history before. So, well, actually for world wars we have, but that's kind of what it's like.
Well, I think a lot of people don't understand the compounding impact of impairment that happens. So when and everyone's levered, it's not just not the people in their households that are levered. If you're living in an apartment complex and you can't pay your rent to the landlord, well, the landlord's levered, to high heaven, and they're going to miss their payment to the bank, and then that small bank is going to miss their payment to whoever above that. And I mean, it's just you've got all these compounding
and you just saw it, right? And again, the little guy always gets screwed. And what's interesting is you just saw this, the mortgage REITs, right, which buy mortgage-backed securities. So they bundle all these mortgages into securities, they sell them off, and then these mortgage REITs buy them, and they yield 3 or 4%, and then they borrow at 1%, and they arb the spread, and they lever up 10, 12 times, and it's a great business until it's not. So then what happens is these things get unwound, and if you look at them, they're down 70, 80, 90%, and then what happens? The big distressed guys like Apollo, Oaktree, et cetera, go in and buy the mortgages at distressed prices with a 30% IRR. So the little guy who owned the mortgage REIT in his 401k or 403b or in his trading account is now down over the last 10 years. He's lost almost all his money, and the big guys are going to get richer. And on top of it, those big guys are asking for money to make those purchases from the government. Are you freaking kidding me? Seriously? If we give 1 penny to a private equity firm, I might have to move. I'm not sure where I'll move, but I have to move.
No, I'm with you. It's crazy. I mean, like you saw the bailout for the private jet companies and stuff. I mean, it's just hilarious.
Well, shocking.
I mean, it's not hilarious. It's just you're like, are we even in reality right now? As everything's just flips upside down. It's insane.
But Preston, you made a really important point that I don't want to go unnoticed. And again, that's why I love talking to you. Is you do this all the time. You just throw out a random point, but it's the point. And the point is leverage can never make a bad investment good, but it can make a good investment bad. And I'm stealing that directly from Howard Marks, but he probably stole it from someone else. But that is a truism, and it's always been a truism. And we're seeing it every time there's a crisis. And what happens is there's this thing that John Kenneth Galbraith talked about many, many years ago, and it was called the bezel. And it's the amount of money that's stolen by management teams. And it just happens, right?
It's insane.
People just do it. And what happens is in good times, the bezel grows. So in the roaring 20s, the bezel grew and grew and grew and grew. And then somebody finally says, holy shit, they're stealing from me. Mm-hmm. So bang. And then suddenly everybody clamps down. There's regulations. And we had the 1933 Act and the 1940 Act. And we're going to show those Wall Streeters that they can't steal from us. So the bezel drops. And then people forget, and it goes back up. And then we have another crash, and the bezel drops. And then 2008, right? We had all the stealing, all of the leverage, all of the bad stuff going on in subprime. And Michael Burry comes in and says, oh, I can figure this out. And you guys are bad people. So I'm going to go short, the big short. And boom, he makes a bunch of money. Clients like us make a lot of money. And what happened is people then on the other side of that said, hey, you guys are stealing from us, no more. So we're going to de-lever the banks. We're going to pass a bunch of, Dodd-Frankenstein, as I like to call it, laws that cripple the activities of banks. Now, I actually agree, and I think they should reinstate, the act that they did away with in the Clinton era, that separated investment banking and traditional banking. You shouldn't allow investment banking and traditional banking at the same thing. So I do like that point. But all these rules and regulations then hamper the efforts of the traditional lenders. So what do people do? Then they go into the shadow market. And so now we have all these shadow lenders who, let's just say they're not quite as diligent about how they do due diligence and how they check people out. And so we have loans, again, probably not liar loans like in this 2007 era, but we have a lot of people who should never have gotten loans on property that just can't cash flow, and it's going to go down a lot, and that's going to put pressure on prices.
I think the thing that's just super obvious when you're looking at it from a really large and long time frame is when you have an inflationary monetary policy that has no peg, you have created this massive incentive structure, massive, that leads to exactly what we're seeing. And it should be no surprise to anybody. And for anyone to think that that's magically going to change without something driving that change, they're totally kidding themselves. This incentive structure is only going to amplify itself as we continue to go down this path of creative destruction.
Well, look,
these
Preston,
economies.
I've been tweeting about this all week, and some people don't like it. And this is not just about the virus, right? This whole inequality is being exacerbated. I mean, we just got played like a fiddle. Yeah, I mean, literally, we got played like a fiddle. So, the Fed was tightening, and they're pushing us toward a normal, good recession. People say, well, how can you say recession's good? Recessions are good. They cleanse. They get rid of the misallocation of capital.
Well, and what I would say is it forces it. You can have a peg without a peg, and I guess, or without gold, right? If you control the supply of the monetary baseline by tightening it back to where it originally started, and if you would bring it back to zero, if you expand it by 100 and you bring it back to zero, right? You don't need to have a peg at all. But if you expand it out to 100 and you bring it back to 20, and then on the next one you expand it another 100 and then you bring it back to 40, you have inflationary policies. And so now you're seeing that they're not expanding it by 100, they're expanding it by millions and like it just obscene exponential levels. And so it just, you're at the end game, and that incentive structure that we were talking about has only magnified itself to a point where everything looks like it's just this deformed thing coming out of the microwave, right?
Come on, again, and this is not new. This is the thing that's so frustrating. It's like management books, right? Never pay for a management book. All you got to do is go back to the original manuscripts from 2,600 years ago, from the ancient Greeks and the Romans, from Seneca the Younger and Seneca the Elder or Seneca the Older, and it's all the same, right? I mean, those sayings, which were actually, it's funny, they were actually the impetus for the field manual, the Army field manual, and it's got some long number that became the big thing for management training books. And so all these guys have created businesses around this, but it's all the same. And again, empires fall. Every empire in the history of empires has fallen, whether it was Roman Empire, Ottoman Empire, British Empire, American Empire, in the middle of falling, they all fall. Why? Well, because governments, because these incentives that you described so well, they're incented to overspend, and they're incented to stay in power. I say this all the time. There's no left, there's no right, there's no Republican, there's no Democrat. There's in and out. And when you're out, you do or say whatever it takes to get in. And when you're in, you do or say whatever it takes to stay in. And that's all it is. And so we have the biggest deficits in the history of deficits under Republican administration. That's impossible. Okay, but that's because there's no Republicans, no Democrats. It's in and out. And all this guy wants is to stay in. And so he's doing everything he can. That's what I mean we got played, is the Fed was tightening and they were taking away the punch bowl. He's like, no, I need the stock market to go up. I need liquidity. So he browbeats the liquidity. Well, then they realize, geez, liquidity is not really doing it, because liquidity doesn't solve a solvency crisis.
You were
preaching. For a solvency crisis, you actually need real money. And so we just got so excited, I pulled my headset. The solvency problem is what leads to this big fiscal expansion. And so we just created this massive set of programs. But here's the problem. So the biggest problem we have is all the people that have been told they can't work, right? Bars, restaurants, gyms, car washes, all these things that can't work. So their income's gone. They need help, and they need help fast. So what do? We say, okay, we'll give you $350 billion, which sounds like a lot of money. Oh, but here's the problem. So far, they've had $1.7 trillion of applications for that program. So they said, oh, we'll add another 200 million. I'm like, that makes 200 billion. That's 550 billion, which is still a third of the demand. And that's only after 2 days. So the problem is, where's the other 1.5 trillion going? Oh, we don't want to talk about that because it's a big slush fund for big mutual fund companies, big, airlines and private jet companies. And it's so crazy. And yet all under the guise of, okay, well, we don't have to balance the budget because the Treasury will just print money. I'm like, whoa. If that's true, then why do I pay taxes?
Yeah.
If you don't need my money, then how about I just not pay taxes and you go print the money and solve the problem?
I mean, and just so you're aware, when you were really in your preaching mode there, which I was absolutely loving, I dropped the meme, and I'm sure you've seen this meme of like the mountain man kind of like looking from the side, and he just starts nodding his head, and he kind of I put that on the video, so that's what people saw.
Love it. Yeah, I do get on the pulpit every once in a while. I apologize.
No, you needed to be preaching there. I mean, I just don't really even know what to say. I guess I'm just kind of sitting back and looking at everything that's happening, and it makes total sense from when you understand. I love this Warren Buffett quote. He says, "Show me the incentive structure, and I'll show you the action." Right?
It's all about incentives. Everything's about incentives.
All about incentives.
Everything from relationships, everything to governance, everything to business formation. It's always about incentives. I mean, think about how we make investments, right? If we are incented to buy risk assets because there's no return on low risk assets, guess what we will do? We will buy risk assets. And so that's the whole ZERP and NERP. And that's why, we got our tweeter in chief calling for negative interest rates. Mm-hmm. And then he said, well, okay, but wait a second. If I do negative interest rates, won't that hurt the banks? And don't the banks give me a lot of money? Okay, I don't want negative interest rates. I just want low interest rates. And it's this amazing. I hate to talk about this stuff, but it's like, he was pushing the chloroquine stuff, the drug. Well, it turns out he and a bunch of campaign contributors own the companies that make that drug. Shocking, I know, shocking. And someone asked me, well, why didn't we test faster? Like, well, there's probably an auction on who got to produce the tests. So, whoever paid the most into the campaign. So all of the incentives that you talk about go to where we are today. And that's why I'm so afraid for people who are chasing this little rebound in equities because they don't understand what the incentives are set up to do. The incentives right now are set up to create massive wealth destruction and income inequality. And I will even go further. I think it's set up to create a culture of dependence, called the dictator playbook, that if you want to be, kind of president for life or dictator for life, what do? Well, you give people free money and you create poverty and dependence on government handouts. And that's kind of what this whole response looks like it's trying to do, which is frightening to me.
It's getting pretty interesting. Here's a question I want to throw up there. Hey, Preston, do you think, and obviously Mark too, do you think we will have a potential for high inflation to occur due to quantitative easing in bills passed? If so, I didn't even read it fast enough. Hold on here. If so, are we to expect interest rates to ultimately increase in the future? So I have an opinion on this, and I'm very curious to hear your thoughts on the opinion, Mark. So I think what we're going to see is we can't afford for interest rates to go up.
Nope.
You can't, the real estate market, everything. I mean, it's just going to be a total bloodbath and disaster if interest rates go up because all financial assets are priced off of those interest rates. And if they start going up, everything falls apart. Mm-hmm. So the government's going to step in. They're going to continue to do not only UBI, and UBI is going to be in many different forms. It's not just going to be, money that shows up into your bank account. It's going to be relief on your mortgage payment. It's going to be in all these different forms, but effectively what it's doing is it's UBI. So what I think you're going to see is they're going to be doing a lot more UBI, which they haven't done any to date, but you're going to see a lot of that tool being used. Mm-hmm. But it's not like QE is going to go away. they're going to still be doing QE, and they're going to be effectively pegging interest rates at 0% across the whole duration of the curve, clear out to the 30-year mark, right?
Yep.
So where I think this is going to confuse a lot of people is they're going to be looking at the bond market, and I think a lot of people make a really simple narrative on the health of the bond market. They're saying, well, the yields aren't moving all over the place, therefore it's a healthy bond market. There's nothing wrong, right? Yeah. But what they're not seeing behind the curtain is there's tons of people selling those positions because they can see what's happening from a monetary policy standpoint in the printing that's taking place. And so there's people that are offloading those bond positions, and who's the buyer? The government's the buyer. They're stepping in and they're exchanging that cash for those positions, and the yield just continues to stay at 0%. Well, this is going to continue to persist until there's this aha moment of, oh my God, this is a flippin' farce.
It's a farce, yeah.
And then you're just going to see collectively on a global scale, you're going to see the bond market just have total impairment. And it's going to be, it's going to happen so fast at the blink of an eye that if you're sitting on $1 billion bond tranche and you work for a bank, whatever, it's just going to be, it's going to have gone past like the speed of light, that transition into whatever evolves into being the next currency. It's going to happen so fast, they're not even going to have a clue as to what just happened.
Yeah. You know, it's really interesting, Preston. Couple things. So one, I could talk about the killer Ds. So it's demographics. So it's how many people are there, working age population between 45 and 65. That's good. When you have a lot of people 25 to 45, that's bad. You have high inflation. And that if you see all the countries with inflation around the world, they have lots of young people. And what actually is inflation? Inflation is really just borrowing from your customers in the form of higher prices to train your workers with low productivity. That's essentially what inflation really is. Now, everyone talks about the monetary part, but we'll come back to that. So when you have 45 to 65-year-old people, you have very high productivity, you have disinflation, falling interest rates. When you get 65 to 85-year-old people, you actually have deflation, zero and negative interest rates. And again, we know exactly what's coming because we've seen it in Japan. So we're all turning Japanese. The Vapor song cues here. And we've all got this Japanification that's happening. And how do I know? So I was at this meeting in Tokyo probably 10, 12 years ago. And I was talking to the CIO of the third largest pension fund. And he was 90% fixed income. Okay, 90% fixed income, 10% equities, 3% bonds, 3% JGBs. And of course, me, being the naive, young, smart guy, said, how can you do that? Don't you know about modern portfolio theory? And you have to be at least 60-40, and equity has a risk premium, and you're going to make much less in bonds. He says, I am perfectly comfortable with my portfolio. And I sat there, and I probably told this story for 7 or 8 years, kind of making fun of him, right? The dude has been dead right. He's made way more than anybody else. People don't know. Long bonds have outperformed stocks for 20 years.
Yeah. I mean, I tell people you could have a ham sandwich that could have taken a long bond position back in 1981 and it would have outperformed everybody.
Yeah. So here's the thing. We know that interest rates are going to zero. All of them. Every one of them, right? They're already there in Japan. They're already there in Europe. We're going to zero. All of them in the
Nominally,
US.
Yeah. Real, we're there.
Just zero. Yeah, I mean, just zero. So the only place you can actually really make money in bonds today, I mean, in terms of serious money, is China. You can buy Chinese long bonds at 3.5%. They'll go into zero too and make a lot of money on that. But the demographics is too many 65 to 85-year-old people. 65 to 85-year-old people, turns out they don't spend a lot and they buy bonds. And that's what we have. Every day, 10,000 people in this country turn 65 every single day for the next 17 years. Right? In 17 years, I will turn, or actually, no, in 8 years, I will turn 65. And 9 years after me, there'll be a whole bunch more. And so then in Europe, the same thing happens, 10,000 people. And so that 65 to 85-year-old cohort, they like fixed income. So the demand for bonds is going to continue. Now, the point that you made that's really important is you did see that little freak out maybe 2 weeks ago, where interest rates were like 50 basis points in the 10-year and then shot up to almost back to 1%. And everybody said, see, the bond market, the bull market's over. I'm like, oh, no. You know what that was? Actually, this friend of mine called me Sunday night. I'm sitting there doing my late night Twitter thing. And she said, hey, are you still up? I'm like, yeah. And she said, hey, can you talk? I'm like, yeah. And although, me talking to a woman late at night is like that State Farm commercial. Yeah, sure, it's Jake from State Farm. And so my friend calls me and she says, hey, I just had someone call who's a deep, like not deep state, but like deep inside the Fed, friend from college. And she said that the Treasury market just froze. I'm like, seriously, shut the fuck up. The Treasury market just froze. And what it was literally was, remember when Trump started calling it the China virus?
Yeah.
Okay. He did that because there was an idea, I don't know if it probably wasn't his idea, but somebody's idea in the administration to say, if we say that the China virus caused harm on our economy, we can selectively default on their treasuries.
Wow.
Just let that sink in for a second. Let that sink in, that we selectively default on the risk-free asset. What would that have done to the global financial system the next day? Destruction, like death and destruction. So the treasury market is frozen. And the next morning, that was when the Fed came in and said, okay, 75 basis points, we're going to zero, and we're going to put $1 trillion into the repo market. Now, only 17 billion got drawn, but they said we'll backstop $1 trillion. And the thing is, we throw these T words around now.
Like they're nothing.
$1 trillion. $1 trillion is, you and I will sit here for the next 31,710 years, and we got to come up with a way to spend $1 every second for 31,000 years. That's 1 trillion. One. So I think we're at this very interesting precipice. You said it best. We can't afford, not we, not Japan, not Europe, not anybody can afford for interest rates to rise. Therefore, incentives, they will not rise. So interest rates will continue to go lower. And unfortunately, what that will do is it will make people crazier about this whole Fed model thing, that at low interest rates, stocks should be worth more. People talk about the earnings yield and all this. Well, the idiocy of it is it breaks down below 2%.
Yeah.
Because if you take it to the illogical extreme, if interest rates are zero, are stocks worth infinity?
No.
I don't think that's true.
And that's how the models work. Yeah. For anybody who's listening to this, and I would imagine a lot of people don't know this that are listening to this, when you do these valuation models, is that discount rate gets pushed closer and closer to zero. Just think of it as like you're approaching the speed of light. Everything just doesn't make sense anymore. It's just like these valuations start shooting so far to the moon that it's not even comprehensible. And that's what you're seeing. And that's why none of it's making any kind of sense. So,
but the other thing, Preston, that's really scary, and this actually does keep me up at night because I don't know how to deal with it as, I'm an investment advisor and I have clients, and somebody says, well, how do you deal with being so defensive when the market was going straight up all the time? And I said, look, it's pretty easy. I'd rather lose half my clients than half my clients' money.
Yep.
Right? That's just full stop. But here's the thing that I am struggling with is the dictator playbook. And I talk about this a lot. The dictator playbook is a really simple playbook. You put your friends and your cronies into high-ranking positions. You stuff them with assets and make everybody own the assets, the real estate, the stocks, et cetera. Then you destroy the currency. And I'm actually looking over your shoulder. You can't see it, but over my shoulder on the wall is a 100 trillion Zimbabwe dollar bill. Okay? Wouldn't buy a loaf of bread. 100 trillion Zimbabwe dollars.
Let me grab mine while you're talking. Keep
going. That's awesome.
Keep going.
Yeah. And so the thing is, Zimbabwe did it, and then Venezuela did it. And what people forget, over the last 2 years, Venezuela is the best performing stock market in the world. Number one. And does anyone want to own Venezuelan stocks? Hell no. But if you were at the top of the heap, if you were Maduro and his cronies, you got really, really, really rich owning Venezuelan stocks as Oh my God, that's so awesome.
This is my bookmark in my Big Debt Crisis book.
That is truly dazzling. I love it.
Here it is.
Oh my gosh, that is so cool.
Yeah, it's pretty cool. And I have it bookmarked on a very strategic page inside of this book.
That is awesome.
Let me read this real fast because this is my favorite part of this entire book. This is like an action novel for me.
And this was not planned. This is like
no.
This is my 9-year-old's favorite word, serendipity.
All right, I have it highlighted right here.
Yeah.
Can reserve currency countries that don't have significant foreign currency debt have inflationary depressions? While they are much less likely to have inflationary contractions that are as severe, they can have inflationary depressions, though they emerge more slowly and later in the deleveraging process.
Yes.
After a sustained and repeated overuse of stimulation to reverse deflationary deleveragings. I mean, there you go.
Actually, read that again. No, I'm serious. Read that again. Everyone on the air here, please listen to this and listen to the words that he just said. Okay, repeated stimulus.
Yeah.
To combat deflationary deleveragings, right? The big deleveraging that Ray Dalio talks about. Yeah. So it's the perfect passage.
Yeah. I mean, it's right there. And I think where everyone's kind of confused is they're looking at what's happened in a lot of these smaller countries and they're saying that can't happen here because we're global reserve status.
Right.
Right. We're the only show in town. We can do whatever the hell we want.
Mm-hmm.
And this is not addressed very much in this book. There is literally page 40. I got to put my bookmark back in there.
Yeah, good.
Page 40 of Big Debt Crisis. If you don't own it, I would highly encourage that you get a copy of this book. That's pretty much where you find it. And there's because there's no other example in time where you've had a global economy that had no peg amongst any country.
Correct.
Right? You've never had that before. Yeah,
I mean, look, and what people are forgetting, right, is everybody says, oh, isn't this like 2008? Yeah, not really. Not really. And the reason I say that is because the banks are not as leveraged as they were in 2008. We don't have the real estate fraud that we had back then. We have a equal-sized corporate debt bubble in the sense of it's as big as the real estate bubble was, so it could do as much damage. It's actually closer to 2002, okay, early 2002, post 9/11, where we were all afraid, we didn't want to travel. All the cruise lines, all the airlines, all the hotels were all going to go to zero. No one was ever going to travel again. We were all going to be shut up in our homes because the terrorists were going to come from the Middle East and they were going to show up in America, and we were freaked out. And then the Patriot Act got passed, and we had some of our liberties taken away, and boom, everybody went back to work. And then 2002 happened. Well, what happened in 2002? Enron went bust. WorldCom went bust. We had a massive debt bubble crisis, starting with that deleveraging. That's when Ray started writing about the deleveraging, the beautiful deleveraging theory. But he wasn't talking about 2002. He was talking about 1932. And what people don't seem to get, because you never see it in any of the charts, is people say, oh, this is like 87. Oh, this is like 94. Oh, this is like 2000. No, we're in 1930. We are sitting in 1930. The stock market just went down 30%. Now it's had an 18% bounce. Okay, just like 1930. I mean, almost precisely the number, 18%. And that's the return to normal. Everyone's seen the great bubble chart, right? It goes to the new paradigm, and then it corrects, and then it goes back. It's back to normal.
I literally have the chart on the screen for people to see as you're talking. Awesome. As you're talking about this chart. So keep going. I'm sorry I interrupted you. I just wanted you to know it's on the screen.
That bull trap where you go back to normal, and that's where we are. Everybody's saying, hey, buy the fucking dip. And pardon my French, although I said that once with a Frenchman, and he said, well, why do you say that? We're not vulgar. I said, I don't know why you say pardon my French. I don't know. So I'll cut the swing. But buy the FD, BTFD. And my point is, no. We are in STFR, sell the frickin' rip. And every one of these little moves up, you should be selling into, not buying, because we are on the verge of a 1930-esque contraction in GDP, may actually be worse than the contraction in GDP in 1930 because we shut down the entire global economy, similar to a world war. Although we are not at war against a virus. And we're using that term to try to get war powers so the government can take more liberties away that they shouldn't have any right to, because we are not at war. The virus is not an enemy.
Let me throw a wrench in. So I've still got this chart pulled up. That's the 1929. Like it shows people how difficult this would have been to navigate, because you're looking at the first pump lasted almost what was it, a year, almost an entire year of up move before you had your next correction down, and it was another 50% down.
Yes.
So let me just throw a wrinkle in this, because really what you're getting into is, especially because all the global markets are completely harmonized in the way that they're dealing with this, because none of them have a peg. So you're having this battle. The governments are in this battle of fighting the use of these tools that they have. And if they use some of the tools, it's going to create this environment that creates a lot of inflation. You have with respect to the prices of goods. And if they continue to use another tool, the QE, you're going to continue to see price deflation on the CPI index, but you're going to see the acceleration of prices on assets.
Yes.
So as they try to balance these two tools, it gets harder and harder as time marches on, because now you're at the end game of all of this.
Yeah.
And when you look at a country, if you go into a country that's experiencing hyperinflation, their stock market goes up. I'm going to remove this chart here. So I guess my concern, and I don't really know the answer of one way or the other. I'm trying to keep as open of a mind as possible. But if governments collectively are going to continue to exercise the QE tool, and they're going to continue to go into negative rate policy, and let's just assume that somehow they're able to continue to navigate that, even though there's now this decentralized thing that could peg them like that. Let's just assume that that's not in play, and let's just assume that governments can actually implement negative interest rate policies because everything's digital at this point.
Yep.
That could have the potential to cause the market to go back up to the previous all-time high, maybe even higher, if they continue to insert via QE. I'm just trying to understand the array of potential outcomes, right?
It's the $6 trillion question.
Yeah.
And you're exactly right. It's the thing I've been thinking about pretty much nonstop for the past 3 weeks, that if you think about where we are, right? We had this response to a threat. Now, we have lots of threats, right? We have influenza threat, and we have swine flu threat, and we have tuberculosis threat, and we have malaria threat. And so we have all these threats, biological threats. Then we got other threats, right? We got oil wars, and we got drug wars, and we got all kinds of threats. And never before, well, I shouldn't say never, very rarely in history have we had a response that dwarfed the threat. And I'm not saying that this is trading, people say, this is trading grandma's lives for the economy. That's not the point. The point is that, there are going to be 2.9 million people that pass away this year in the United States. And they're going to pass away from something. And if it's COVID, it could be the flu, or it could be pneumonia, or it could be tuberculosis, or it could be cancer, it could be heart disease, it could be a stroke. But that doesn't actually change that much. And so the threats are going to continue to be around in the world. But this response has put us in a place where now there's had to be a level of response, which is what you're talking about, which is this coordinated global. You just heard Japan come out tonight and say they're going to throw their $1 trillion at this whole thing. And so everybody's trying to throw money. And I'm with you, Preston, that the risk is that we get the nominal inflation of asset prices.
That's really important what you just said. Yeah.
Yes. And that nominal inflation of asset prices appears to be a good thing to people. Well, except the 49% of people that
if you're
don't own
sitting on
stocks.
if you're sitting on the shares.
Yeah. Well, look, if you're in the top 1%, this is your crisis, baby.
Yeah.
In fact, I think Wells Fargo, right? Interest rates have cratered. Wells Fargo will not give you a refi unless you deposit $250,000 with Wells Fargo. So 1%, you're good. The 99%, suck it. And that's crazy, right? If you had $250,000, you probably wouldn't need a $250,000 mortgage. But the so crazy about right now, and the part that I'm really struggling with, is that passage you're reading from the debt book, which is deflationary deleveragings should lead to bankruptcies, should lead to reallocation of misallocated capital, should lead to recovery of growth and expansion of normal market function. Price discovery would actually happen, right? The bad companies would go down, good companies would go up. And that's what's happened pretty much every time.
Well, you're describing free markets.
I am describing free markets, I know, and that's part of the problem. But today, what we have is unfree markets. One of my favorite charts, and I don't have it around, but one of my favorite charts is the one that shows if you invested during the day in the last 5 years, you've made no money. All of the return happens between the closing the previous day and the opening the next day. All of the movement. So it's all going, again, to the rich, to the jump trading and the citadels, and it's not actually going to the people that are trying to trade. Now, if you buy and hold forever, then that's fine. But I just think we're at this really funny place where what I'm trying to discern is it possible, like in 2009, and in 2009, the world was ending, people were scared, things were bad, and we pulled out this tool called QE. And people didn't really understand what it was. And Ben Bernanke didn't invent it. Right? We did it in the 30s. In the 1930s, we were an emerging market run by a gang, actually run by one gang at that time because the Italian gang had beaten the Irish gang. The movie Gangs of New York is so cool. You see, from 1860 to 1920, kind of dangerous to live in the United States. Emerging market, nobody liked us. We were, low-rated debt. No one would buy our debt, so we bought our own debt. We did quantitative easing. And it worked up until 1929. 1929, Roger Babson famously says in September 1929, I repeat what I said last year and the year before. So he had said in 1927 and in 1928 that a crash is coming and it could be terrific. And people said, well, you said it last year and the year before, and you were wrong, so you're definitely wrong this time. So they didn't listen. And Irving Fisher said famously, no, stocks have reached a permanently higher plateau, that they can't go down. So then they dropped 30%, to your point. And so then for about a year, we went up 18%. And it was really tricky. And I wrote a piece about this called Welcome to Hooverville. And I wrote it 3 years ago. And it was after watching Ferris Bueller's Day Off. And so I had written a letter called Save Ferris, Fairus. And it was all about the Trump campaign and why I thought his campaign was just like the movie Ferris Bueller's Day Off, and that he was probably going to end up being like Herbert Hoover as president. And we were going to end up in Hooverville, okay, which is, we'll call it Trump Town now, which is towns, because what Hoover did in 1930, and Congress too, wasn't just Hoover, is they did all the wrong things from a policy perspective at the wrong time. So they put in tariffs. Where have I heard that word before? They had the Mexican Repatriation Act, where they marched Mexicans back to California. Back to Mexico from California, some of them being U.S. citizens. So there was this anti-immigration thing, this America First, which they stole from the Germans. And it was all about nationalism and populism and independence from the global economy. And therefore, we're going to put up these tariffs. But what they forgot is what happens when I throw up tariffs. Well, then Preston, you throw up tariffs. Yeah. And then we don't trade. And so global trade dropped. The dollar collapsed. Gold shot up. Everybody wanted to own gold. So then what'd they do? They banned gold. They made it illegal for a person to own gold. And they confiscated it. So from 30 to 33, the market was down another 50%, as you talked about. And look, when I look at the policy decisions in Washington, I think they're exactly the same with one caveat, and you pointed it out. The fiscal and monetary bazookas could, I think, generate a nominal bubble that, again, will look like it's creating wealth, but that wealth's going to go siphoned and funneled into the top 1%. The poor are going to get really poor in this environment, and we're already seeing that, right? The response to the virus, and that's why I say it's just not about the virus, because you got, Japan. Japan's had, I think, 105 deaths, like 4,000 cases, and they declared a national emergency, a state of emergency. Really? You need police state powers for 100 fatalities? I just don't think that makes any sense. So it's something else. And if it's about creating this inequality and this dependence, and then how do you win an election in that environment? We hand out money. That's what they do in Argentina.
So, Mark, I'm of the opinion that we've heard that the first UBI check is coming out to assist, and this is just kind of a, hey, we're going to help you get through this. Then after, and I guess I'm extracting what I think the messaging is, or the narrative is, which I don't think is what the truth is. So the messaging is that we're going to supply everyone a check to get them through this difficult time where everyone's been forced to not work. For all the small businesses, we'll give you loans. We'll provide you the capitalism that you say you want. And then for all the large cap companies, we'll give you the socialism that you're not asking for, but that will continue to supply, so that you can just take your money and you don't have to pay it back with any kind of interest or anything. Yeah. Right. So under these bills that are passed and the UBI checks, the couple that are going to go out, my opinion is those things are not getting turned off anytime soon, especially with an election coming up in November. I'm curious, do you have an alternate opinion? How could that be wrong? There's no
I don't
way.
think it's wrong at all. It frightens me to the core, because again, it's the dictator playbook, right? How did Christina Kirchner get elected in Argentina? She gave people free electricity. Then she got kicked for corruption, and now she's back as vice president, so she doesn't go to jail. And how did she get in? Because they promise, free stuff. And it is definitely the way to help, quote unquote, the dependents that have been created. So if you think about what just happened, right? We put 20 million people unemployed. And again, I think that number is probably light. 10 have reported so far. I think another 10 this week and next, and probably that number will end up being light. And it's not going to get restarted very quickly. And so you're going to have a lot of people unemployed, probably as great as the Great Depression. Are we going to have a dust bowl? I don't think so, because there's enough fiscal spending that'll get some stuff ramped up. But the problem is the money that you talk about, socialism for the rich and capitalism for the less rich. The socialism for the rich isn't going to get spent. There's going to be no multiplier effect.
No velocity of money whatsoever.
No velocity of money. Yeah. And you can see that in the velocity of money. The velocity of money continues to fall. And look, if I have $1 and I take that $1 and I go get a haircut, and then the haircutter goes to the store and buys a shirt, and then the shirt maker goes to, the hotel and spends the night, and then the hotelier goes to the butcher and buys a, side of beef, and then the butcher goes, wherever. So then there's velocity of money. But right now, what's going to happen is that $1,200, a whole bunch of it's going to go to pay rent, and some of it's going to get saved, some of it's going to pay off debt. Because that was the other thing. Retail sales last year were up 3.5% or something like that, but personal debt was up 5%. So it wasn't that the consumer was strong; it was that they were given free money, right? You saw all the people in the airports giving you free, credit cards again. And so I think we're at this really funny place where the top is really happy because they're getting really, really rich in this environment.
Yep.
The bottom is really, really unhappy, but they're not taking up pitchforks yet. And they're saying, well, if they'll pay me enough, UBI, to your point, then I won't go get the pitchfork. And I wish I knew that threshold, right? What is that threshold? Because I'm sure we've all, people on this call tonight, I'm sure people know people who have been really hurt, right? Touch wood, I have a salary job. I get paid whether, I go to work or not go to work or sit in my house and try to work. That's the other thing is, there's this interesting dynamic. Remember when we went from business dress to business casual? I felt like there was this big drop in productivity. There was definitely a drop in professionalism, and the auditors that did Enron were the first to go casual, and then they let Enron.
So you're not digging the Mark Zuckerberg look? Yeah,
not really. And I tried actually to reinstate business dress at the office, and the guys were like, "Well, you have to give me a raise to buy ties." I'm like, oh, geez, you give me a break. So now I think the problem is people are realizing, well, I only really need to work 3 or 4 hours because I get all my work done on Zoom and stuff. So if I'm in the office, I'm chit-chatting or, walking around, talking to people. And I just think productivity is going to take another hit. And then there's going to be the people who really are displaced. And I think they are the target of that UBI that you talk about.
Well, I mean, you got to think of it from this context. At least my opinion, you got to look at it from this context. When you have inflationary policies, you are incentivizing investment, and you're incentivizing investment to make productivity that much faster and price deflation to occur. Like you're effectively like hitting the afterburners on a jet when you're implementing inflationary policy. So if you do that for 80 years, what you're effectively doing is you're taking something that should take 200 years and you're pulling it to the left and you're smushing it into an 80-year time frame.
Yep.
So when you're at the very end of that cycle, you should suspect that people are able to, well, hell, I can just get everything done in 3 hours because everything is so Zoom and I don't even have to catch a flight now. I can just get on Skype. I mean, look at what we're freaking doing right now. We've got, 600 people in this conversation listening to you and I, which would have never happened 10 years ago.
Or from all around the world.
From all around the world. They're able to comment. I'm able to drop it in there. I mean, it's getting crazy. And then you're wrapping artificial intelligence on this. They're turning this into a article, which then is automatically posting into Yahoo Finance. And it's flipping crazy, man. Yeah. So when you have incentivized and you've pulled productivity to the left for 80 flipping years, you have to get to a point where the system cannot handle it any longer, because as long as you continue to produce that incentive structure, you're just going to have the support structure for the number of human beings that are in this system are just going to start to melt out of the system because they cannot continue to produce and compete at the level that they need to compete with. It's just crazy. But
no. Look, again, you bring up all these really important points, and it is this acceleration of a trend that's been going on for a long time. And that's why everything happens faster, right? We had the fastest drop. Now we had this fast recovery. The thing about markets, there's this famous strategist, Bob Farrell, who was at Merrill Lynch. And he said that, bear markets are very predictable, right? They have the fast down, the reflexive rebound, and then the protracted fundamental drawdown. And so we had the fast down, fastest in history. Now I've had the reflexive rebound. And now I think we're going to have the, come to Jesus reality check. Oh, wait a minute. Earnings really are. I saw one of the questions from earlier was, our estimates that S&P earnings are going to be $100. Okay, think about that. If S&P earnings drop from, at the beginning of the year, they were going to be closer to 200. So they're actually going to be 100. If they're 100, then the PE ratio's got to drop, because that means earnings growth is not growing as fast and revenue growth isn't growing. So let's put a 15 multiple on that. That's 1,500 on the S&P. That's an ugly drop, even from where we are today. And that would probably be closer to fair value. And then, forward-looking returns would be actually pretty attractive. So I think the problem I still have is, I was looking at a bunch of companies tonight before we got on the phone, that there are companies selling at 20, times revenues still. I mean, I don't understand how does it, I mean, 10 times revenues was tried in 2000. You know, famous Scott McNally, you know, if you pay me 10 times revenues for my company to make a decent return, I have to give you 100% of my revenue for the next 10 years, which is kind of hard because I have to pay taxes. So if I don't do that, I go to jail. Plus I have 40,000 employees and I got cost of goods sold. And so it's probably not going to happen. His stock went down 98%. Sun Microsystems went down 98%. Cisco went down 84%. And the big four, the Fab Four that everybody loved, right? Cisco, Intel, Microsoft, Qualcomm. If you own the Fab Four for the last 20 years, now 20 years is a long time. 20 years is a long time. You have a negative return. And so now everybody's got the fangs and like, oh, this is awesome. And they can never go down. And Amazon's great. And Amazon's going to rule the world. Yeah, maybe. But I've started to see incremental anecdotal evidence that people are saying, well, Amazon's wait lines are too long, so I'm just going to go direct to this company, or I'm going to go direct to that company. And then you got the problem that Facebook and Google ad revenues are going to drop 20 to 25% this year.
Yeah.
Their revenues are going to drop because we're shut in. We can't, you know, people aren't going to pay for advertising. So how should you value a company if their revenues are going to drop 20%? Not at 30, 40, 50 times earnings.
Yeah.
So I just think we're at this really interesting place. Yet, I will say it's a non-zero probability that all the stimulus does counterbalance the negatives. I mean, we can just do a little math, right?
I mean, you have to do it as you transition into whatever the next currency becomes. You have to do this.
Yeah. That's
right?
And that's the key, right? That's back to the first question about Bitcoin is why is Bitcoin eventually going to have a greater market cap? It's because, like gold, and think about it, gold is the largest currency in the world. And it's not close, right? Gold is bigger as a currency by a factor of 2 than the US dollar, right? There's twice as much gold. So if of the 8 trillion, I think 5 trillion of the 8, I gotta get these numbers right. It's 5 something of the 8 is jewelry and art and stuff, but 2.5-ish trillion of that gold is actual, you know, bars and coins and bullion and you know, the US dollar is like 1.7 trillion. So quite twice as much. It's bigger. And if you look at all the other currencies, you know, the oldest currency in the world, the pound sterling, is my favorite story. 381 years old. When it was originated, a 1 pound note got 1 pound of sterling silver. Today it takes 274. So the devaluation of that currency over the long term has been immense. And back to the empire thing, remember, the sun never set in the British Empire for 70 years. For 70 years, they ruled the world. The pound sterling was the most powerful currency in the world. And then they invaded Mesopotamia, incurred a bunch of debt. The pound sterling collapsed. The dollar ascended. We became the superpower. Then we invaded, coincidentally, Mesopotamia, incurred a bunch of debt. The dollar collapsed. The renminbi ascended. And then the renminbi will become not a world reserve currency. Why did they become a world reserve currency? Because petrodollars started to fade. The Chinese saw that and made a way for oil transactions to be denominated in renminbi. So now we've got the race to be the first digital dollar. And this is a big thing. Whoever creates the first digital currency, and I actually
you basically mean a tokenized
dollar, currency, yeah. Not a cryptocurrency. A cryptocurrency is a decentralized currency like Bitcoin or Dash or Monero or Ethereum. I mean a digital dollar, a digital renminbi, a digital what the heck's the Russian currency? Ruble. Yeah, ruble. So a digital ruble. So it's going to be one of those three. And the reason I think it's going to be China is China has figured out, see, here's the thing. 30 years ago, you know what the goal of the Chinese party was? The actual written goal for the next 30 years? A harmonious rise. Mm-hmm. Doesn't that sound beautiful, non-threatening, so nice? Their next 30-year goal, to become a global superpower by 2050.
Yeah.
That's a little different. Now, how do they do that? Well, they have to have a currency that is more broadly accepted. So I always say, I hate to quote Ricky Bobby, but if you ain't first, you're last. And whoever is first with the digital currency wins. And that's why the U.S. should be doing everything they can to
Why is that? Why do you say that?
Because if you're in Venezuela and the bolivar is getting crippled because Maduro is stealing all the money with his cronies, you seek dollars. If you could seek a digital renminbi, you would go to that, right? It's harder to get physical paper dollars and dangerous. You get shot or,
You're saying because they can swap, they can basically do not.
You can go to your computer and put your fingers on a keyboard.
Swap it immediately.
And swap and get real digital currency.
Yeah.
Now, what they did is they started using Bitcoin and Dash and others. But the reality is whoever gets that first digital currency is going to have widespread adoption on a global basis. And look, we're at this point where we're at Cold War with China, right? There's a Cold War over 5G and AI. Then we've got this hot war on the verge of going on with Iran. And that's an interesting place for the U.S. to be, stuck in the middle. And I heard a very scary thing. And I don't normally agree with Nouriel Roubini, pretty much never. But I force myself to watch people and listen to people who have differing opinions because I think it's important. So I watched his Real Vision video. By the way, anyone on the video who doesn't have Real Vision, get it. Watched his Real Vision thing, and it was funny. I watched it. It's like 72 minutes. I changed my thumbs up, thumbs down 7 times. At first, I was like, "Oh, this is good. No, this is bad. Oh, this is good. It's bad." Because he's really smart, but he's such a bombastic jerk. I ended up thumbs down, but there were some good points. And one of the points that he made that was frightening to me was he said, by fall, Iran is going to attack the United States, not physically in the United States, but through a proxy, either Saudi or Israel. I'm like, holy heck, that's a big call. I mean, that's a big call. But here's the scarier part of this. 3 years ago, right as Trump was getting elected, I was at Kyle Bass's annual meeting, and he had a guest speaker in who was part of the Secretary of State Department. And he said, over the next 4 years, the 3 things you have to worry about are North Korea, South China Sea, and Iran. And we're all going, no. It's a Middle East war. It's Iraq. No, North Korea, which sure enough, we had the North Korea thing. Now, there was no there, but we had to talk about it. South China Sea is still a big, big deal. I mean, seriously big deal because it matters a lot to the Chinese and Iran. So you got this guy talking about 3 years ago. You got Roubini talking about it now. So I think there's something there. And the one thing that makes me less worried about it is China figured out 10 years ago that the next war will be fought with chips, not ships. So it's about cyber power. And that's why everybody says, China can never be a superpower because they don't have enough aircraft carriers, which I know you're familiar with aircraft carriers. But they can because aircraft carriers probably aren't as important in a cyber world as they once were. So it's drone technology, it's AI technology, it's cyber warfare, cybersecurity. And that's where I think China has spent the last 10 years becoming so good at AI, 5G, and overall technology.
So I guess if I was going to push back on the argument, I would say if you have something like Bitcoin, decentralized, any country can ban it, but if you do, well, there's others that are interested in keeping it around, right? Especially after dollar dominance over the last 80 years. So as long as that's there and it's completely decentralized, no one can go in there and adjust this protocol. As long as that's the reality, if the U.S. tokenizes the dollar or the Chinese tokenize the yuan, I don't think it really matters. I think what it really would matter at that point, whether people actually want to have utility in those tokens, is if it's not being continually debased by the nation, right?
You are 100% right?
Yeah.
Bitcoin is superior to all digital currencies because, as you said, it's a deflationary model as opposed to an inflationary model, right?
That
You
no one can
cannot,
change.
you and I cannot decide tomorrow to change the number of Bitcoin. There's gonna be 21 million minus what's lost. That's it. And then we can go down to Satoshis and we get 100 million Satoshis. But the reality is we know the monetary policy of Bitcoin every day for the next 100 plus years. That's given. It's a beautiful model. It's a genius model. Satoshi, whoever he, she, they are, is a genius. Okay, but you're exactly right. So much money is eventually going to go into Bitcoin that it is going to be a reserve currency, potentially could be the global reserve currency in a borderless world, right, which we're moving toward, right? If we all just figured out that digital's here and we can all work from home, we can be connected like this online in real time on a global basis, and the borders don't matter, there will be some country that says, you know what? We want you in our country. We're not going to have borders. We're going to have a digital country. Someone's going to do that. And then the digital currency of choice, I do agree, becomes Bitcoin, because Bitcoin wins. Why? Because it was first. Doesn't have to be best, just has to be first. That's
everyone trusts
return.
it. And everyone trusts it because there's no one managing it, which
exactly.
sounds totally counterintuitive to what
it's that's why I call what's coming in 2024 the trust net.
Yeah.
Right? The trust net, which is going to be bigger than the internet in 96, bigger than the mobile net in 2010. The trust net is when everything is connected, and it's all connected through this Bitcoin mechanism. So Bitcoin definitely wins, but as an interim step, I think the digitization of currencies is going to happen. One, for control, because command and control is important to governments.
I've got a question here I want to throw up here because this kind of relates to exactly what we're talking about. So Boris B., he writes, if anything replaces the US dollar as a reserve currency, it will be the IMF's SDRs. Mm-hmm. That is it. So I like this argument because it's something that could potentially compete with Bitcoin or this tokenization thing that we're talking about. I don't want to say my opinion. I want to hear your opinion.
Look, I totally agree, and I think that's kind of why it was created. And I do agree it's a step function, right? I do think the next step is for the dollar to lose world reserve currency status and for something to replace it. I had always thought could be the renminbi, but I don't think they're ready to go full convertible, full open kimono. So they made it into the SDR, and so the SDR makes perfect sense. And I do think what Bitcoin is today is it's opt-out insurance, right? It's schmuck insurance, right? You opt out with a certain portion of your wealth. And until we have the second layer and the third layer, and they're coming, right? I mean, there will be Bitcoin as a base layer, kind of like TCP/IP. On top of that, there'll be another layer like FTP for file transfers or SMTP for emails or HTTP for web browsers, and there will be these other layers on top, and there'll be Lightning Network as a payment rail, and we're working on a company right now that wants to transfer money on the debit rails, and basically, because think about it, why for years have we paid Visa and MasterCard 3% to transfer money? It doesn't make any sense.
Because they could fetch it.
Yeah, exactly. Because there's no other alternative. Yeah. Now there might be an alternative.
Yeah. Oh yeah.
Because of technology.
So this is my. I want to hear your feedback on my narrative or whatever you want to call this. But on the SDR, I'm just looking at it as it's Libra. It's what Facebook was trying to do, right? That's all it is.
Yep.
But instead of a company like Facebook, who has some of the best programmers on the planet, implementing it at lightning speed because they have the war chest to put into it.
And all the verifiers that are incredible companies around them.
Yeah, exactly. Instead, you have a World Health Organization-like entity, call it, the IMF, that's going to supposedly roll this out. And I mean, I'm just looking at it.
The idea is great, but look, everything today is about who has the best tech. If you have the best tech, you win. And what you just described, the reason everyone is so afraid of Libra, the reason Zuck had to go, be Robotron in front of Congress, is because people are afraid that, if you have the best tech, you win. And what you just described, the reason everyone is so afraid of Libra, the reason Zuck had to go, be Robotron in front of Congress, is because people are afraid that, if you have the best tech, you win. And what you just described, the reason everyone is so afraid of Libra, the reason Zuck had to go, be Robotron in front of Congress, is because people are afraid they do have the best programmers. They do have the best network. And Libra is the gateway drug, right? It is the gateway drug so that 2.4 billion people would suddenly have a digital asset in their digital wallet. And then they would say, well, wait a minute, that's centralized and can be seized. Why don't I have a little bit of this Bitcoin thing because it's decentralized and can't be seized? And hey, it has a deflationary monetary policy. And hey, it has store of value. And hey, it's going to be the base layer for the digital world going forward. I like this. So look, I'm trying really, really hard to have Morgan Creek be one of the verifiers for Libra because I still think they're the way to go because they're far superior to the IMF, as you said.
Let's just play devil's advocate. Let's play. I love playing out the scenarios of both sides, like both sides of the argument, because that's how you typically unravel the truth, right? So let's just assume that the IMF is like just best programmers you can possibly. They can let that contract. They can stand that tokenized SDR up, right? They're going to put it in place. They've got their basket going, and as all these countries are debasing their currencies, the global SDR that's tokenized, like if all that plays out, it doesn't change anything to the narrative on the bullish case for Bitcoin whatsoever at all.
Not even a little.
Not even a little.
Zero. No
Zero.
Change. No change.
Zero.
It actually accelerates it.
It accelerates it. Yes, because everyone's just going to swap into that common currency and boom.
Everybody will have a wallet. Everybody will see the ease. And the first time that you do a transaction with the SDR and you get denied because you tested because you tested positive for COVID, so you can't buy that thing. And
then you get all these nations that are gonna wrap the data into the tokens, right?
Oh yeah.
Oh, everyone's gonna want to sign up for that.
Look, I forfeited my privacy a long time ago. I get it. I'll take convenience. I'll give up privacy. But there is a limit. And that's why I do believe that you need some portion of your assets outside the big fiat currency system. I think that fiat fiasco, as I like to call it, that started in 1971. Well, I started in 1913, accelerated in 1971. And this last couple weeks is really the knee of the curve towards destruction of all currencies. And when I say destruction, I just mean the devaluation. Like I use the example all the time. I'm old. So I ask people, what's the lowest price you remember for gas? For me, it was 31 cents, Totem Lake, Kirkland, Washington, 7-Eleven. And I was visiting my daughter in California, before the crackdown or lockdown, and paid $4.29. Same gallon of gas. Does the same thing. Actually, it's a little less good because of ethanol in it now. But let's just say it's the same gallon of gas. Does the same thing. Why am I paying 8 times as much? Because, right? Actually, more than 8 times. Why am I paying 12 times as much? Because it's devaluation of the currency. Yep. It's not that the gasoline got better. It's that my currency got worse. And that process of making the currency worse, this is the most heinous crime perpetuated against humankind in our lifetimes, is that the inflation is good for you. That 2% inflation is good for you. That is a crock of whatever. And it's designed to transfer wealth from the less well-off to the more well-off. That's why we have the greatest income and wealth inequality in the history of mankind.
So I completely agree with what you just said. I would say that the academics will try to defend it by saying, well, the population growth, if it's 2%, then you need a currency that expands with the population growth so that it's really kind of this steady state of water, right?
That's not bad. But they don't match. Yeah, they don't match.
But in reality, it's not implemented that way. It looks like it's being implemented that way because they're measuring inflation based off of this pretty little basket that they have specifically and neatly defined. I had a friend tell me, if you ever want to understand why you're in an argument with somebody, understand the definition of the terms that you're using, because that's probably where the argument is actually the root of the argument occurs, right?
So good.
So when you talk about inflation, it all comes down to how do you define deflation? Or I'm sorry, deflation. How do you define inflation?
Inflation.
Well, if they're saying, well, this little basket right here where there's some oil in it and there's this in it and there's that in it, that's inflation. And when it's 2%, well, gosh darn it, our inflationary monetary policy is 2%. But they know, the actors at the central banks know darn well that their monetary base is not expanding at 2%.
Oh, no, come on,
right?
7.
Yeah. So
for sure.
So
yeah.
How it manifests itself, particularly over the last 10 years with QE, is as they're expanding that monetary base, it is nesting itself into the scarcest type assets. So that's your stock market, right? That's your bond market. That's where the inflation is nesting itself, and it's nesting itself in those asset prices going up. Well, what do all
nominal
the people?
Returns.
That's right. It's all those nominal returns that are going up. And so what do all the owners of those securities think in their brains as that's happening? They're thinking, I'm really good at this.
Oh, I'm smart.
I am a great investor.
Absolutely.
You know what? I only had 2% down in like the last swing. It's all crap, right? It's all this fiction ego trip that they've told themselves that they're this amazing investor, when the reality of it is you have just straight Cantillon effect occurring where the money's being pumped in, it's going straight into the bond market, and then the people who are receiving that, the value of the bonds are going up, the yields are going down. They're then buying shares back with their equities if they want to push it into the equity market. I mean, it is just, I get to these points sometime, especially on Twitter, where I just want to scream, because you get these Wall Streeters in particular that think they're so smart with what they're doing. But in my very humble opinion, most of them are effing clueless.
Yeah.
Absolutely clueless.
It's so well summarized. I don't even have any comment, because it's perfect. I mean, exactly what you said is this. It's an illusion of skill, and it's an illusion of gain, and it's because of manipulation, right? 40% of the CPI is owner's equivalent rent, which is the rent you charge yourself if you rented your house from yourself, which you would never raise. So it's zero. But housing prices don't go up zero. And the ones that people talk about all the time are other things like healthcare. Look, healthcare's biggest scam. We shouldn't even call it healthcare. It's not healthcare. It's sick care. It's claims processing. We have nothing to do trying to make people healthier. That's why we have huge epidemics in obesity and diabetes, and again, that's all big food companies, and another topic for another day. But the other one is higher education, right? Higher education. Well, no one pays the sticker price. Not no one, but very few people pay the sticker price. So that sticker price goes up a lot, but everybody's getting scholarships now and fellowships and grants, and so what they've done is they've this inflation for buildings. So every college campus you go onto now has great giant buildings, and it's like an arms race, and then also high salaries for people who work there. Now that's about to change. I don't know if you guys saw the Stanford announcement: 20% cut for administration, salary freeze for 20% cut for the leadership team, salary freeze for administration, so that they could keep increasing salaries for the base level people.
And what's the endowment there? What's the endowment size?
$28 billion. But now one thing about endowments, $28 billion. The thing about endowments that people don't understand.
Teach me.
No, it's not a piggy bank, right? There is a Preston Pish, right, scholarship for left-handed tuba players. Now, if there are no left-handed tuba players, I can't give it to a right-handed tuba player, as much as I would like to. Now I could go back to you and say, hey, we don't have any left-handed tuba players.
To the tune of that much money, $28 billion?
The vast majority of endowment is what's called restricted endowment. It's restricted to a scholarship, a fellowship, a professorship, a chair. Vast majority, 80, 90%. There is a little bit of unrestricted endowment that could be spent, but here's the problem. You can't spend the principal. If you give $1 million, And let's say the market goes down after the first year.
Yeah, I got you. Yeah, you're talking the yield.
If it goes down 10%, I have to get back to the $1 million before I can spend. I can never spend the principal, which makes sense because what you're trying to do with an endowment is ensure intergenerational equity. So you don't want to overspend in the current generation and rob from future generations. You don't want to underspend in the current generation and rob from future generations, because an endowment literally lasts in perpetuity. So I have to give that left-handed tuba scholarship every year forever. And I have to recognize that tuition is going to go up. So I have to beat the 5% spending plus inflation every year, which means my real return has got to be 5 or 6%. That's a tough bogey, actually. So pick on the endowments, but endowments are so amazing because they truly allow you to hire the best faculty, attract the best students. My wife and I set up a scholarship at Notre Dame, and basically we set it up so that we would get all the kids that were going to the hypes, right? Harvard, Yale, Princeton, Stanford, and ours called the Hesburgh Yusko Scholars Program. So it's the same 4 letters, the hypes, but that we wanted those great leaders to come to Notre Dame. And we get about half, right? We don't win. We win about half the time because we give them a scholarship.
Because of the football team.
Money sits in the endowment. Well, sometimes football helps.
I had to take the stab.
You're from Alabama.
I had to take the stab right there. Boom, I had it.
You even got the Alabama red on the microphone.
Come on, man. I'm right down here in Graceland.
It is unbelievable. I mean, like nothing no one's ever seen it. No one's ever seen dominance like that.
That's right. Alabama strong, baby.
Alabama, baby. All right. So what final closing topic do we have?
So this is a question, and I think for people who have heard some of my previous podcasts and things like that, I talk about the bond market really kind of being the thing that's going to cause major disruption for the currency in the end game. And so here's a question that John asks. John asks, could you explain why the bond market will melt down when a currency transition occurs? I would just describe it as this. Your debt, so like when you bought your house, that you sign a contract, and in that contract, it specifies what the denomination of the debt is. And so if the debt's in dollars, that means that the contract that you have with whoever the other entity is going to be repaid with those dollar bills. You can't use euros. You can't use Bitcoin. Yen. You can't use anything other than that denomination unless the bank would step in and say, hey, that'd be fine if you paid me with, you name it, currency. They'd have to make a modification to the contract. So that is why when you get into a situation where no one trusts the currency anymore because there's been so much debasement in order to pay for things like UBI and for free this and for free that, and here's another $10 trillion we're going to pop into the market. Oh, here's the euro. It's going to do 10. Now the US dollar has to compete with the euro that just debased by another 5 trillion. So like you have this competitive devaluation that's happening around the world.
Yep. Race to the bottom.
That's right. And then you're going to see, in my humble opinion, you're going to see some alternate venues of currencies that are going to start running away.
Yeah. Yep.
And when you see those start running away in price, there's going to be more and more people that are going to say, I don't trust this thing over here.
Exactly.
I don't trust it at all. Like what the hell am I doing keeping my money in that when my neighbor is just bought a brand new whatever?
Yeah.
And I don't trust this anymore. And so then what you're going to have is this point where governments are going to have to basically take complete ownership of their debt markets. And it's going to be such a race to sell
Preston,
those positions.
We know that that's the case, right? Yeah. I mean, we absolutely with certainty know. Think about this. I mean, I have, actually it's out in the other room. I have in my bag, I carry it around all the time, a Roman solidus, right? It's a little copper coin. At one time, over 2,000 years ago, it was the most currency in the world. In fact, the word solid comes from that. If you had a solidus, you were solid. You were a citizen of Rome. And so most powerful currency in the world. Today, it's worthless. I bought it in Italy as a trinket. And of the paper currencies in the history of the world, there were 875 paper currencies. 72% of them no longer exist. 72% of all the paper currencies in the world, starting in 1300 with the first, yeah, there it is.
And keep going. Don't let me slow you down. I'm just getting the lullaby out.
All of that is proof of what you just said, which is every empire, every government eventually succumbs to the allure of massive devaluation of their currency. Because look, once you're overly indebted, there are only four choices. You can pay back the debt, you can default on the debt, you can restructure the debt, or you can inflate away the debt or devalue the currency. Well, we can't pay back the debt, right? We've reached the level of what's called Ponzi finance, right? If you think about the first stage of finance is called hedged finance. I lend you $1 million knowing that you can pay me both principal and interest. Then you go into speculative finance. You just bought a second house. I know that you could never pay me back the principal, but you can still pay the interest. Then there's Ponzi finance, which is I'm going to lend you this money to buy your third house, your rental property. And I know there's no way you can pay me the principal back. No way you can even pay me the interest. So as long as you flip it and pay me, I'm good. So that's where we are today. We're in this Ponzi finance world where the government's no way can pay it back. We can't default on the debt because then you get kicked out. If you're the president or the treasurer or secretary of treasury, you're out. You can't restructure it because that's almost like default. And so the only choice is to inflate it away.
So this is a different section of this book.
I love it.
Page 60. Tabbed, highlighted.
You are.
I'm a nerd.
I thought I was good as nerds go.
I am a total nerd, man.
Yes.
I mean, you saw me on the VR headset last night. I mean, we were on my rooftop throwing virtual sandbags at a cornhole game.
I know and I got my Oculus right there, and I didn't get.
I was disappointed you didn't join me last night. All right, so page 60. Investing during hyperinflationary events for central banks, and I think it's important for people to understand this really important point. You're going to hear people say, "Oh my God, we got hyperdeflation happening." You have deflationary prices that are just crushing the markets right now. Due to inflationary monetary policy. Okay, that's a really important thing for people to understand the nuances between these terms. And again, it goes back to when do you have an argument with somebody? It's when you have two different terms that you're working with. So It's important for people to understand that whenever I say this, because what we're seeing from a monetary policy standpoint with the debasement and the printing that's just never ending is, in my opinion, we're getting to these levels that you might even start throwing around the word hyper in front of the word inflation. Investing during hyperinflation has a few basic principles. Get short the currency. Do whatever you can to get your money out of the country. Buy commodities and invest in commodity industries like gold, coal, and metals. Buying equities, buying stocks, is a mixed bag. Investing in the stock market becomes a losing proposition as inflation transitions to hyperinflation. Instead of there being a high correlation between the exchange rate and the price of shares, there is an increasing divergence between share prices and the exchange rate. So during this time, gold becomes the preferred asset to hold. Shares are a disaster even though they rise in local currency nominal terms.
Exactly. Venezuela.
And bonds, and there's no wiggle room in this text that says, and bonds are wiped out.
Scary. And what's so scary about that, right, is it's theft. And it's intentional theft. And it's theft by the government and the kleptocrats at the top of the government and the cronies. And that's why I get so upset on Twitter about this. It says capitalism's dead. No, capitalism's not dead. We don't have capitalism. We have cronyism or crony capitalism. If we could go back to capitalism, Glass-Steagall was the act I was trying to think of earlier. If you could go back to real capitalism, where we could go back to proper allocation of capital, proper pricing of capital, proper price discovery. See, I'm a big person. They should have closed the markets 2 weeks ago. Having the markets open every day, fluctuating 6-7% up, down is just stupid. It's just a casino. And if the world is shut down, businesses are shut down, trading floors are shut down, people can't function, the machines are in charge. It's just, it's horrific. And people think that an up day is good, but go back into your history. This is good. If you go back in history, you will never find one big up day. By up, I mean up 3, 4, 5, 7%. Not one. Never in a bull market. They all occur in bear markets. And that's because a definition of a bear market is a market that goes down most days, but goes up sharply on good news, or more importantly, perceived good news. That's where we are.
My final point on when you said, what they're doing is it's criminal how they're basically stealing through these mechanisms. But I would tell people that their only other option, because it all comes down to your opportunity cost of what else could you be doing.
Yep.
Well, their opportunity cost is austerity. Their opportunity cost is that they literally let these businesses fail at a enormous level. They let these JP Morgans just let it fail.
Yeah.
We'll just have to find something else that'll stand up.
That's what Iceland did.
And you can do that, and that can play out. And then this all would actually be, you're going to get to this
hard. Look,
reset's very hard, and especially when you're trying to get elected, it's very hard when you have the choice between austerity and
but you're not going to choose austerity if you're in, right? If you're in, you don't choose that. And look, reset is hard, and the decisions, like I'm big, no bailouts, right? I don't want one penny to go to any company, especially the people who levered up, particularly the people who levered up to buy back shares. Just that's your fault, right? So now you don't have any money for a rainy day. And look, people say, oh, this was foisted on us. Yep. And so you restructure. And equity is a risk asset. And here's the thing. If we socialize the risk of equity and we make it riskless, then we destroy capitalism. Because now we will have total misallocation of resources. We'll have lack of price discovery, and there's no differentiation between risky assets and unrisky assets. The whole system breaks down. And so we have to penalize the bad actors and the people who chose to play a game of enriching themselves at the expense of margin of safety for the business.
I'm sorry, I got to put one more on here.
All right.
David Wong, he writes, markets will 100% go up over time. So I just have a comment about this because this is a really important point for people to understand. Yep. If you're talking nominal terms in this currency that we're talking about, you might be 100% true. But here's the thing. Your buying power relative to something else, i.e. a new currency, will go down. And that is a very important point for people to understand is you might be right all day long in nominal terms, but as far as your actually buying capacity and your buying power, that's the thing you got to protect. And that's the thing that a lot of people lose sight of. They think in nominal terms. They don't think in buying power terms.
The myth of nominal returns is one of the most important things to not get sucked into. And this idea that markets always go up, well, sure,
in nominal terms.
In nominal terms, not in real terms. But the problem is the way math works is it could take you decades, literally decades, to get even in real terms. As I said, if you bought Microsoft, Intel, Cisco, and Qualcomm 20 years ago and held them to today, in nominal terms, you're still down. So you can say the markets went up all you want, but if you bought those Fab Four that everybody said we can't miss, you haven't made them, and in real terms, you're down even more.
Page 60, that's why he says what he says, is because he's looking at it in buying power and not in nominal terms. Yeah. Anyway.
Incredible.
All right. That was fun, Mark. We need to do this,
fun. And
we need to do this more often.
Is as a night owl, like I could do this all the time. In fact, like I'm just getting warmed up at 11:30, so I could go till 1 o'clock. But I do have to do a little prep for tomorrow. But
I appreciate your time, sir. I really do.
This is great. And I don't say this just because you're here. I mean, there are not that many people that I would do this with, and you are one of them. And I could talk to you all night long.
Likewise.
You just great questions, great preparation, and
great audience.
Great audience.
We got the best audience, the nicest audience.
Yeah, great questions. Great
they're
audience
looking.
questions. Yeah. So thanks for doing it. We'll do it again. And it was fun to be with you.
Thank you, sir. You have a wonderful night.
All right, you too. See you, man.
Bye.